My experience with Alpha so far has been nothing short of exemplary.
The word that would best describe them, I think, would be trustworthy.
They're just a fantastic group of people.
We have a fantastic team in Alpha Wealth. We're all fully qualified individuals with over 60 years of combined experience between us.
I've spoken to so many different people that they feel like they've just like an extra cousin I've never met before, and they're always there with a kind of a helping hand to do whatever I need.
They have a very professional approach, and you feel like you're getting advice that you can trust and rely on.
They're a company that I would definitely recommend to friends and family. Nick and the team are there at the end of a phone or at the end of an email, and they will always come back to you.
Alpha Wealth provide a full range service to our clients' needs, just to make sure that you're doing the right things for you and getting the most from your own money, getting it working harder for you and ensuring that your family are protected.
Good evening, everyone. Thank you very much for those of you that are listening to this live. And just to mention, my name is Nick Charalambous, and I'm the Managing Director of Alpha Wealth. I'm joined this evening by two of my colleagues, Keenan Cunningham, who's our Head of Marketing and Business Development Manager, and also Clean O'Donoghue, who is a fellow Director of Business Development. So tonight's presentation is just going to be around 30 minutes, and I'm going to focus on what we said initially was 5 top tips for 2023 to save you money. We've actually extended that out to 14. I see somebody's raised their hand there, so one of my colleagues will look to address that. I hope you guys can all hear me. Okay, so essentially what we're trying to do this evening, guys, is give you some tips. We'd like to try and make this as informal as possible. Just before we start, my colleague Keenan's going to throw up a poll. We just want to get sort of a sense of where people are at with their financial goals for this year. And as I said, please do feel free to ask any questions in the Q&A function. So just while I give you a moment or two to maybe answer the poll questions, and as I said, please do feel free to put any questions into the Q&A. We will address them either this evening or we'll get back to you directly. So just before I start, just to mention briefly about Alpha Wealth, for those of you that are not familiar with us, I know many of you have listened to previous webinars, and this is the first of a series of webinars we are doing on a weekly basis, and I would encourage you to look out for them. Again, Keenan's going to put into the chat function the upcoming webinars that we're doing over the course of the next number of weeks. The next one is going to be this coming Tuesday, the 16th of January at 1 p.m. And my colleague David is going to be talking to Ian Slattery, he's Head of Investments in Zurich. And it's a really good, I suppose, sense of where markets are, particularly for anyone who is interested in, I suppose, getting a feel for where their pensions and savings plans are and what they can expect for this year. So essentially, the main theme of today or this evening is around what you are looking to achieve in terms of your financial goals, helping you to rationalize your finances into short, medium, and long-term pots. This phrase that I suppose is becoming a bit of a buzz phrase, which is called pay yourself first. I'll explain that as we go through this. And I suppose to finish off, what Alpha Wealth can do for you and help you on your financial journey. And as I said, we are going to do questions towards the end. And my colleague Cleaner will be asking and taking in questions as we go through.
Nick, can I stop you there? Because I'm actually online. I had just a bit of difficulty joining. If you wouldn't mind, just I'll start my video if you can allow me to start the video.
Absolutely.
Good evening, everybody, and welcome to this evening's webinar. So I'd just like to start off, Nick, by just kicking off the evening and I would really encourage everybody that's on the webinar this evening to make it as interactive for everybody and as beneficial that you would put questions into the Q&A function at the end, and we will address these questions throughout. But just to start off, I suppose for a lot of us, Christmas, we've overspent. And I just wondered, what's the best tip for starting 2023 on a good footing?
So I suppose really the first tip that we're going to talk about is the financial budgeter. And really, it's the best tool that I can encourage all of you to use over the course of the next week or two. It's something that I've done every year. I'm 49 years of age. in my working life, and I find it to be really powerful. The problem we have is that a lot of us, particularly, as we're coming out of the restrictions that we faced, we're starting to spend more, and it's really a great way of focusing what you are spending your money on. The tool that we offer, and as I said, Keenan's going to provide the link for anyone here, is a great summary at the end where it helps you in a very simple way, just format what you're earning on a net basis and also what you're spending. It only takes about 10 or 15 minutes. I encourage you to do it with your online banking app open, or indeed a month's worth of bank statements. And the key thing to get from this is, number one, to find out what your potential savings amount should be. And this was what I was saying earlier about pay yourself first. I really want you to think about reframing your finances and ensuring that you are saving and that you're dedicating your money into savings, whether it be for short, medium, or long-term savings. And then you spend what's left over rather than the other way around. So again, the key tip.
When you look at this, how much should people save versus spend, let's say, on a monthly basis? Are there any hard and fast rules? When you look at this and when you put in the figures that you need to put in, but are there any hard and fast rules around what people should save versus spend on a monthly basis?
There's an approximate rule of thumb, and again, it varies on the specific individual, but approximately a third of your income should be on savings in those different parts that I've mentioned. A third of your income generally tends to be around your spending, whether it be on certain things that you want to do and so on and so forth. And then the final third on essentially paying back loans and debt.
And what kind of loans there are you kind of referring to when you mention loans?
Primarily mortgages. Mortgages tend to be kind of a large component of that, inclusive of other things like insurances and, as I said, short-term debt and so on and so forth.
So for anybody on the call this evening trying to get on the property ladder, or maybe with a mortgage where they might be on a tracker and they can see that interest rates are increasing, where's the best place to go for advice on mortgages or for the best rates?
So for anyone who has a mortgage at the moment, I would really encourage you, and it's a really short window of the next 2 to 3 weeks, to look at your situation in terms of your mortgage and speak to your current bank about the possibility of refixing your mortgage now for at least 5, tending to 10 years. This would include those of you that have tracker mortgages. It is an opportunity. A lot of people who have had trackers, who have benefited from very low interest rates for the last 13 and 14 years, I would seriously encourage you to consider the rate that you're on versus what you can get with your bank. For those people that are looking to get a mortgage, I would encourage you to speak to an independent mortgage broker. We provide mortgage advice. We don't provide mortgages in Alpha Wealth. We prefer to stay independent. And there is still an opportunity for people to take advantage of what are relatively attractive rates. An example of which is Bank of Ireland have a 10-year fixed rate, currently varying between 3.1 and 3.5%, depending on your loan to value and whether or not you would apply for a green mortgage or not.
So you mentioned a third for saving, spending. The banks, post office, credit unions aren't giving very good returns on money at the moment. Where is there kind of a good vehicle, or where would you recommend people saving money this year?
So the 3 pots that I always refer to, the short-term one being 0 to 3 years, you have to stay in the banks, post office, credit unions. It's just too short to try and do anything other than that, where you don't earn money, but it's safe and you can use it for things like, some big expense that you might have this year, next year, and the year after. However, for those of you that are looking at a financial objective over 3 years plus, and this is up to kind of retirement age, I would seriously suggest that you might consider looking at an alternative. Typically through Zurich, one of the insurance companies. We operate as an independent broker. Anyone who's heard me speak on any of the previous webinars, and they are available on our website to download, and some of them I would encourage you to listen to. I think they're very useful. we talk about, you know, how you can benefit from interest that is applied to these accounts. And for those of you that can see on the screen there, you can typically expect interest of at least about 3.5% per year. And the example I've used here on the slide is that in order to build up 30,000, which tends to be a sort of a meaningful sum for anyone who wants to try and get a deposit together for a property purchase, for a new car, for a wedding, for children's third level education, over a 4-year period, it would require you to save about 570 euros a month. However, if you have a lump sum, I'm using an example here of 8,000 euros, that would enable you then to get to the same point with 400 euros a month. The key thing is, if you don't put it into an interest earning account and leave it in the banks, let's say, you need to save the equivalent of 625 euros a month. So you're basically throwing 55 euros a month down the drain. The examples on the bottom of the screen show that over lesser amounts, how long it will take. But in order to answer your question, Clay, there are certainly better options out there. And this is an account that I encourage all of you to consider. It's really flexible. You can stop, start. We offer it at a 0 entry fee and a 0 exit fee. So there's no cost to enter or leave the plan. It's completely open-ended. And we offer it at the lowest management fee of all the financial institutions out there.
So then, Nick, you know, I suppose when we first sent out the invitations for this webinar, one of the questions that came back most frequently was advice around how to save money on tax that we're all paying. So can you give us some tips around how to save and reduce the tax we pay each year?
So this goes into tips 3 and 4. The best, I suppose, short-term tax vehicle for anyone who's earning over 40,000 a year is a government-backed scheme called the Employment Investment Incentive Scheme, or the EIIS scheme. And it's become, I suppose, more mainstream. We've been pushing this for the last number of years. It's been available since 2011. In its improved, modified form, which Pascal Donoghue essentially announced 2 years ago, it enables an individual who has 5,000 euros in the bank, who's earning over 40,000 a year, to benefit from investing in an Irish company. There's about 70 each year that look for this type of finance, where the government will give you 40% back of tax that you've paid in that calendar year by virtue of you invested in an Irish company. And there are some very, very strong companies. We have spoken extensively, and there's a couple of examples there on the screen. Blacks of Kinsale is a court-based company, Halo Care, who are a medtech company, which we have basically narrowed down this market. And the key opportunity for people is that by investing 5,000, you get 2,000 back from the government, with the view that at the end of the 4 to 5 year period, you get your 5,000 back plus interest of approximately another 20%. It's a double your money scheme, and it is something that, again, to answer the question about getting tax back, I'd encourage any higher rate taxpayer to at least consider. You can make an informed decision based on the companies that are being presented, and this is our role in Alpha Wealth as an independent broker. The second, I suppose, tax scheme, and one that people sometimes may not necessarily realize how advantageous it is their pension scheme. Many of you may have a pension through your work. You may have an independent pension scheme. And the key message really for this evening is that if, again, you are subject to tax at a high rate, i.e. you're earning over 40,000 a year, you can get 66% of a return by making a contribution into your pension scheme. It is enormous. People often ask me, what is the best investment? And I say to them, it's by putting money into your pension. And what probably turns some people off is that they don't necessarily fully understand the nuances of pensions, or they don't like the risk. You don't have to take risk with your pension. You can stay in a very secure account. And more importantly is that you can access your pension scheme from age 50 onwards. It doesn't have to be this thing that is so far away that you can't visualize it. And it needs advice. And this is where I would encourage all of you to maybe make sure that you're checking in with an independent financial advisor and getting appropriate advice about where you are today and where you're looking to get to. And that's something that we help our clients with.
So Nick, on that, I'd like to ask you one of the first questions that's come in, and it's around advice for somebody who's working in the IT sector, who regularly changes jobs. And they just want to have pension cover for periods in between probation periods where they cannot join the company pension. So what advice would you give to that person this evening?
So they should make independent pension contributions. We deal with a lot of people who work as kind of contractors, and they're in that scenario where they don't have the ability to either join a pension because they're working remotely to the company, or that they have to go through probationary periods. But you have the ability still to fund a pension and get that 66% return that I've referred to. And in some instances, if you are in a situation where you have to wait before joining the company, you build up your reserves and then you maximize the benefit of the pension once you're eligible to join. So for example, as you can see on the screen there, let's say that you're in your 40s. That enables you to put 25% of your income. Let's say you're on 50,000 a year. 25% of that can go directly into your pension, 12,500, both for this year and for the previous year, once you become eligible for the pension scheme. So there's great scope either within that company scheme when you're entitled to, or just to do it separately. But again, it comes down to advice.
Okay, so I'm going to jump back now to the EIS scheme. So this is a question around, so this person's understanding of the EIS is that your capital is not guaranteed and no return is guaranteed. And you mentioned that there is a 20% return on investment. So can you just give clarification around that, please?
Yeah, so that is correct in saying there's no guaranteed return of capital or interest. And you would recognize that by the fact that anybody that tells you you can earn more than 0% is telling you that there's risk associated. The key thing is, though, again, and as somebody that has availed of the scheme directly myself, what I would say is that you have an opportunity where to reduce the tax that you pay, because that is guaranteed. So the 5,000 investment example that we're using, you will get 2,000 euros back from revenue. The company that we recommended last year, one of them was called Blacks of Kinsale. Fabulous company. You know, their turnover is north of 1.8 million. They made a profit in 2021 of 625,000 euros. The company is growing. You can have a look at their balance sheet. You can have a look at any information you require. You can go down and visit the site Kinsale that they're developing. It's a multi distillery, the first of its kind in Ireland. And it's a fabulous team that run the company. So whilst your capital is not as secured, it is backed by the company. You essentially become a preference shareholder in that business. And the return that they're offering, the 20%, I've actually underrated what they've offered. It's 28% over the 4-year period. It's a 7% return per annum. But it is a case of trying to weigh up risks versus reward. And in my opinion, I think this is a very advantageous one.
So this question then is around somebody paying their mortgage. They said that they kind of have these ongoing chats in the house around whether they should pay off the mortgage at the end of the month, the extra money that they have, pay off the mortgage, or whether they should keep the savings and put it away for something else. Now, they've said that they're very disciplined savers, but between herself and the spouse, they disagree on what should be done with the extra money at the end of the month. So do you have any kind of direction around this?
Absolutely. So firstly, I always talk about return of investment. The answer to the question is, what are you going to do instead? What's the opportunity cost? So, for example, I was speaking to clients earlier today who were overpaying their mortgage by 100 euros a month. And I asked them why, what were the alternatives to them? Were they taking advantage of the pension opportunity, which they weren't? And I encouraged them to stop overpaying their mortgage because they were only saving 2.5% of the interest that they were fixed on. And they were missing out on the 66% gain on their pension scheme. For other people, it might be a case that they might have a car loan. And again, like that, you need to focus on what is the best return of investment. I had a client last week who had 30,000 of a car loan and yet had 10,000 euros sitting in the bank. And they were asking me about what they should do in terms of investing the 10,000. And I told them to pay down the car loan. Why? Because they were paying interest of 8%. You won't get that ever on a tax-free, risk-free investment. It's the best investment you could ever get in your life. And yet they couldn't see the opportunity. So again, like that, what I'd say is it's about finding the right balance. Some people are not comfortable with debt. Some people don't mind it. But more important is to understand what is the return of investment, what's the cost of debt for you as a percentage, and are you taking advantage of the best opportunity you have?
So moving on to the next question. If you have 30,000, what's the best thing to do with it if you are not maximizing your ABCs but cannot afford to pay ABCs without spending the savings?
So we're back to these three different pots that I refer to, the short, medium, long term. There's no point me telling people to put more money into their pension if they have objectives that require that money before they're going to reach the retirement age, even though I've suggested that you can stagger the time that you draw your pension schemes down from 50 years of age onwards. But again, there's a little bit more guidance needed here. But what I would say, it's that there is an opportunity for that person to spend some of the lump sum that they have on the pension contribution. You can do it by way of a bullet payment. You don't have to fund it more aggressively. And I prefer people to use this balance. Again, I have lots of clients who they want to keep this kind of rainy day fund, you know, this whole kind of subscription to like 3 to 6 months of their gross earnings put away, because that was the old adage that advisors used to sort of spin. I don't, buy into that. I feel that you should get your money working for you. And as long as you have enough for an absolute emergency, make sure that you're sweating your money. And in my view, having that sort of money in the bank, you need to start thinking about putting the money away as quickly as you can. Plan early, guys, is the main thing I'd say to you. And then you don't need to have as much pain getting to the same point.
So we mentioned earlier around kind of switching in relation to mortgages. So this person has asked around kind of switching with legal fees. They're so high these days and there's no competition. Is there anything people can do to reduce these, or are any banks who are offering support for switching legal fees that you know of?
I mean, legal fees are approximately about 1,500 euros. So in context of the house purchase, they're not massively high, particularly in relation to the savings that you should be able to achieve if you are switching your mortgage. But I go back to what I said earlier. In 90% of cases, you don't need to switch your mortgage. You need to get the best mortgage that you can with the existing bank you're with. You know, I've mentioned Bank of Ireland, but PTSB have some attractive rates, again, for those who are fixing. And the main, I suppose, message really is that by staying on a fixed rate, even if it's attractive, if you are going to come off that over the next year or two, you have to be very cognizant of the fact that the interest rate environment is going to be very different. You know, we're relatively lucky in Europe versus the US and the UK, which have seen even more steeper raises in their interest rates, but we're not quite at the top of the cycle yet. And it is a different world to what we've been used to for so many years. So again, what I would say is try and get your mortgage sorted in your current bank. It's going to be a lot less painful. It's going to be a lot easier. And respectfully, the time it's going to take to switch your mortgage, it may well be too late.
So this is going back to the first question again about kind of whole IT sector. And I suppose there has been a lot of changes in the whole IT sector. And in relation to people working in that sector with kind of company pensions, is there any advice that you can offer for somebody who may be, maybe made redundant and has a company pension from a previous employment? Any advice that you can offer for somebody, I suppose, around?
Yeah, the pension landscape has changed somewhat. And again, I don't want to sound like a broken record here, guys, but getting proper professional advice from an independent broker, I think, is key. That example, for example, would be that, let's say somebody has a pension scheme from a company like Twitter or, working in Amazon or whichever company it might be, and they are made redundant or they decide to leave for whatever reason. They may have a pension fund gathered of 20, 30, 40,000. And that pension fund may be accessible from the day they turn 50. So it's really worthwhile looking at what your options are, because sometimes by making a decision, even at that stage, you may commit yourself to something you didn't necessarily realize. The other thing as well is around, do you leave the pension where it was with that previous employer? Do you move it into the new company arrangement you might be entitled to do? Or do you look at another alternative? And this is why advice is so important. I can't stress how worthwhile it is to speak to a qualified professional.
Another question, Nick, is around somebody that has sold a property recently and has a lump sum. So should they invest it, or should they pay off a mortgage that they have?
I'd like to suggest again this whole concept of finding the right balance, and this is where I'd like to think that we would come in and helping people to understand around how the best use of those funds would be. If I was in that situation, I would explore all options. I would certainly maximize my pension in that year. It's a massive opportunity, and the sooner you do it, the sooner you can basically retire. Paying down debt would be sensible, particularly as we know interest rates are rising. So depending on if you want a really good fixed rate now, I wouldn't be overly anxious to do it, but I would align yourself to the fact that maybe when you come off that fixed rate in 2, 3, 4, 5 years time, you'd be ready then to take a lump off the mortgage at that stage, but you sweat the money in the meantime. And then investment options, we've talked briefly around the Zurich account, which I think is a fantastic, easy access account for people. There's no time limit to it, and it works extremely well for various different purposes. But also the ESS scheme, which is a limited opportunity. It's likely it's only going to be available for the next 2 years if it lasts that long. So this is certainly potentially one of the last years it will remain. And then it's a case of looking at other alternatives depending on your own situation.
So I know you've mentioned that you have 14 tips, so I better let you kind of get back to going through some of them.
Yeah, so I'm just going to rattle on, guys. One of the other things, and I suppose, look, again, some of you may or may not be familiar with the rent-a-room scheme, but for those of you that are slightly struggling and have the opportunity to rent a room in your house, I do think it's one that sometimes maybe people don't consider, particularly with the fact that, obviously accommodation is such that for those of you that maybe have a child that, might be living away from the home now, that you can rent a room in your house and get up to 14,000 a year tax-free. I've spoken about fixing your mortgage, which is the 6th tip, but also the mortgage protection scheme. We're coming across more and more people who are paying 50, 75, 100 euros a month for a policy that they were basically instructed to by the bank that lent them their money. And they basically played on fear. And by the time people got to meet the, I suppose, financial advisor / mortgage protection advisor, as I've been called in the past, they were so tired they just wanted to sign a form to leave their office. I do think that anyone who's paying over 25 euros a month for mortgage protection, which is a policy you have to pay for, is paying too much, and I would encourage you to get someone to review it. House insurance is another plan that people are paying a lot more for, particularly as house insurance costs have gone up by about 60% in the last 12 months. And you want to make sure that you're not being caught out by lethargy, by not shopping around aggressively enough. And as an independent broker who doesn't provide it, we can help you get the best rates through various brokers that we use. Same with car insurance. The next couple of tips really around loans. I've spoken about dealing with the highest interest cost first. I did a podcast earlier for the journal, and they asked me around credit cards, and I'm not a lover of credit cards at all. I understand why some people have credit cards, and I was offered a credit card through Revolut yesterday by a click of a button, and it was scary as how easy it was to actually get it. And I suppose really what I'd be saying to you is just look at the cost of debt and why it's really important to focus on the highest cost of debt first. If you have a credit card, car loan, a mortgage, the main focus has to be on the credit card first. Get rid of it and then focus on starting to whittle down, obviously, the car loan next, and then you look at your mortgage. Health insurance, it might, I suppose, surprise you that, there is a huge opportunity for people. Some people have health insurance through their companies and think that there's no options for them, and yet there are. I talk to clients all the time around typically what tends to be the gold, silver, and bronze plated plans, and I say to them that there is benefit in kind on health insurance. It's not a free benefit, make sure that you have the right type of plan for you. Are you availing of the various claims that you can make on expenses? And also, if you are paying for health insurance yourself, take advantage of online discounts. I have 4 children, and I've never paid for more than one of them. Why? Because I take advantage of the offers through the various different providers. There's 3 companies in Ireland that offer health insurance, and I make sure that I shop around every year, and we can give you guidance and advice for that. In terms of savings, some people may have savings already set up with the likes of Aviva, Irish Life, Zurich, or whoever. And what I say to them is it's the right type of plan, but it may not be the right type of product. And it's always important to check what fees you're paying. I've seen horrific fees that some people have been charged by brokers that are essentially taking money at the start, on the management fee, and also at the end. And I do think in this climate, it's really important to be discursive. And I suppose the last tip I'm going to mention just before any further questions come in is give back your company car. Might be easier said than done, but because of the changes to benefit in kind that have taken effect this month, it has become a lot less attractive to have a company car. And if you have the ability to maybe give the car back, or indeed if you are coming towards the end of the tenure of a company car, I would seriously encourage you to take the expense against it instead. But again, I can go through that in a bit more detail with you if you'd like.
So I'm going to jump back in with 1 or 2 more questions that have come in. So getting rid of a credit card, do you mean pay it to 0 or clear and close the card? Doesn't that have an effect on your rating?
There's a misnomer about having debt, how it builds up a record. It's completely hogwash. I am talking about getting rid of it. Now, if it's to a point where you can't do that, then look at the option of trying to transfer the credit card and avail of the 0% interest for a period. And you can box cleverly in that. But credit cards are a massive no-no, guys. And anyone who engages in Alpha Wealth, I'm saying to you, we can get you to get rid of that credit card debt by the savings that we can give you on the other plans that I've discussed tonight and help you in terms of dealing with a financial budgeter. And I suppose the main aspect of how we're helping clients is that we charge for a financial consultation. Many of our peers, the likes of Owen McGee of Prosperous, who's on television, charge what I think are excessive amounts for these financial reviews. We have a fixed cost review of €199. And for the month of January, for anyone who does attend any of the webinars, it's reduced down to €99. My colleague Keenan can put up the code if anyone would like it and wants to book in for a financial review with us. Or indeed, you can email me directly at nick@alphawealth.ie. But that is the all-in cost for anyone who wants to avail of the 1-hour full review service that we do provide.
So how is tax reclaimed from the government on pension contributions to a personal PRSA? Claim once per year or monthly?
So for anyone who pays into a pension scheme, independent of their work employment, essentially what happens is that you get a cert from the company that you take the plan out with, and that goes into the tax office and they apply the credit of 20%. The further 20%, if you are a high rate taxpayer, then is claimed at the end of the year. And again, we can help you with this. It's very simple on the Ross system. There's no major drama with this. That's typically how the year is how the claim is provided.
And the other question is one that actually comes in really regularly. It's a great question, and it's can I just ask what you recommend to save the children's allowance, or how to save it, where to save it, what are the best options?
For anyone who has more than 3 years before they need the money for their children, it is that Zurich savings account that I mentioned earlier. It is fantastic. There is no other form of regular savings plan that I could suggest that you should consider. And as I said, we can help you understand the options within that. There is a risk reward table. So again, depending on your time scale, we can help you understand about how that can work favorably for you. But the returns that we've averaged for clients over the last 5 years, even with the way that the world has behaved, I suppose, over the last 12 months, has still annualized about 5% per annum. And it will continue to do that over that 3 to 5 year plus period.
So one of the last questions, and if anybody else would like to ask a question, please pop it in before we finish up the meeting this evening. But do you have to have your mortgage paid in full for receiving the HAP payment or the housing assistance payment?
My